We all think about earning rent from a house or a property, but what if I told you that the stocks just sitting in your demat account could be doing the exact same thing, earning you a kind of rent without you ever having to sell them? Well, that's precisely what we're going to unpack today. So, that's the big question, right? Could your portfolio be working harder for you? The answer is yes. And it's all thanks to something called the Stock Lending and Borrowing Mechanism, or SLBM for short. It's a way to put those shares you're holding for the long term to work and generate a little extra passive income on the side. So here's how we're going to break it all down. First, we'll get into the basics of how you can earn rent from your stocks. Then we'll see how a lender and a borrower actually get connected. After that, we'll dive into the upsides and, really importantly, the safety measures for the lender. Then we'll flip the script and look at the borrower's side, their strategies and risks. And finally, we'll get down to the brass tacks. Is it actually worth doing? All right, first things first. Let's dig into the fundamentals. What in the world is the stock lending and borrowing mechanism, and how does it let you lend out your shares in the first place? At its heart, SLBM is actually pretty simple. Think of it as a formal, regulated marketplace run by the stock exchange. If you're a long-term investor, you can lend out your shares to another trader for a set amount of time. And for doing that, you get paid a fee. It's really just a temporary loan, where you get paid for letting someone else use your assets for a bit. And just so you know, this isn't some brand new experimental idea. SLBM has actually been around since 1997. It got a bit of a tune-up in 2010, and it really started gaining traction around 2012. So it's a pretty well-oiled machine in the market today. Okay, to make this all make sense, let's imagine two people. On one side, we've got AJ. He's a long-term investor. He's got a portfolio of stocks he plans to hold on to for years. He's just looking for a way to make a little extra cash from those shares. And on the other side, we have Mara. She's an active trader, always looking for short-term opportunities, and to do that, she sometimes needs to get her hands on shares that she doesn't actually own. So we have AJ who wants to lend, and Mira who wants to borrow. How do they find each other and actually make a deal? Let's walk through exactly how it happens. The whole thing is handled by the stock exchange, which basically acts as the middleman. First, both AJ and Mara can go to the exchange's website to see which stocks are available to be loaned out and what the current lending fees look like. Then, through their brokers, AJ places an offer to lend, while Mara places a bid to borrow. The exchange's system then matches these orders, kind of like how a regular stock trade gets executed. Once they're matched, the shares move from AJ's account to Mara's. And then, when the contract period is over, Mara returns the shares and pays AJ the fee they agreed on. Simple as that. So, how is that fee actually decided? Well, it's basically a negotiation that's handled automatically by the exchange. Let's say AJ wants to lend his 100 shares of SBI, and he's asking for a fee of 1.2%. Mira, on the other hand, puts in a bid to borrow those shares, but she's only willing to pay 0.8%. The exchange's platform finds a happy medium, and bam, the order gets matched out of 1% fee. So in this deal, the lending fee comes out to 800 rupees. Now, there are a few little details about these contracts you've got to know. Unlike your usual futures and options contracts that expire on the last Thursday, these SLBM contracts expire on the first Thursday of the month. You can also roll them over month after month for up to a year. And here's a crucial point. You don't place these orders on your normal trading screen. You have to go through your broker to get access to this market. All right, let's put ourselves in the lender's shoes for a minute. What's really in it for AJ? And probably the most important question, how is his investment kept safe? For the lender, the motivation is crystal clear. It's a way to earn extra passive income on shares you were already planning to hold for the long haul anyway. I mean, think about it. You're putting an asset that's just sitting there to work. You're not selling anything, so you still own your investment, but you get to generate an extra return while you wait. Of course, this is the #1 question on any potential lender's mind. And it's a totally fair question. You're handing over your valuable assets. What happens if Mara, the borrower, just doesn't return them? This is where the stock exchange really earns its keep by acting as a guarantor. If Mira defaults, the exchange steps in to make sure AJ is protected. First, they'll hold an auction to buy those shares on the open market and give them back to AJ. Mira, of course, has to foot the bill. Now, in the very rare case that no shares are available in the auction, Mira has to pay AJ the full cash value of the shares. So one way or another, AJ is made whole. Okay, so what about things like dividends or stock splits? Does the lender just miss out? Nope, not at all. The system is built to handle this. If a dividend is announced, the exchange just collects it from the borrower and passes it right along to the lender. If there's a stock split, the borrower just has to return the new adjusted number of shares. The only time a contract ends early is for things like a company buyback, but it's designed so you're protected and don't miss out on those benefits either. Okay, so we totally get why AJ would want to lend his shares, but why on earth would Mara pay a fee just to borrow them? Let's flip the script now and look at it from the borrower's side of the table. Well, there are really three main reasons. The most common one is to short sell. That is, to bet that a stock's price will go down for more than just a single day. Another reason is to fix a trade that's gone wrong and avoid penalties for failing to deliver shares. And for the more advanced traders, it opens the door to strategies like reverse arbitrage. The more people who want to short a stock, the higher the demand is to borrow it, which means higher fees for lenders. Let's walk through that short selling strategy. So Mara borrows 100 SBI shares when they're trading at 800 rupees each, and she immediately sells them in the market. She's betting the price will fall. And let's say she's right. A month later, the price drops to 775. She then buys back the 100 shares at that lower price. Her gross profit is 2,500 rupees. After she pays AJ his 800 rupee lending fee, she walks away with a nice net profit of 1,700 rupees. Now, that other strategy, reverse arbitrage, is a bit more advanced. This is for traders who spot a temporary price difference between a stock's price in the regular market and its price in the futures market. If the futures price is trading lower, a trader can use SLBM to borrow the stock, sell it at the higher price, and buy the cheaper futures contract at the same time, locking in a pretty much risk-free profit from that temporary glitch in pricing. But borrowing isn't a free lunch. There are definitely risks. The biggest one is obvious. What if the market moves against you? If Mara shorts SBI and the price goes up instead of down, not only does she lose money on her trade, but she's still on the hook for that lending fee. There's also something called foreclosure risk, where the contract could be ended early, forcing her to close out her position at a really bad time. So, we've covered the mechanics, the pros, and the cons. Now let's get down to the practical side of things. When you factor in all the taxes and charges, what does the bottom line actually look like? Is this worth your time? Well, the tax situation is pretty different for each person. For AJ, the lender, that fee he earns is treated as income from other sources, not as a capital gain. And that's a really key point. The act of lending the shares doesn't trigger any capital gains tax. For Mara, the borrower, any money she makes from her trading strategy is just taxed as a normal capital gain. And it's so important to understand how the fees and taxes eat into your final return. Let's go back to that 800 rupee fee AJ was supposed to get. First, the broker takes a commission, which in our example is 20%, or 160 rupees. Then you've got GST on top of that commission. So when all is said and done, AJ's actual take-home from that 800 rupee fee is more like 611 rupees. It just goes to show that while it's passive income, you absolutely have to account for the cost. So there you have it. SLBM is a pretty low-risk way for long-term investors to squeeze a little extra return out of assets they already own. And while the income from a single transaction might seem small, over time and across a portfolio, it can be a really smart way to optimize your returns. So the final question is one for you to think about. Are the stocks in your portfolio ready to start working overtime?